The inflation crisis of 2022 explained, causes and impact on the crypto space. Inflation and its effect on the standard of living is becoming a primary concern for households and policymakers. A rising cost of living affects everyone from rising food prices to paying packets of diminished value. But what exactly is inflation? What causes it? What's its impact on the economy, and how long will inflation be on the rise? In this video, we'll answer all these questions and discover how the central bank will respond to inflation. For the best and latest blockchain technologies, crypto, and finance videos, make sure you subscribe to this channel and hit the bell icon to be the first to get the latest updates and news. So, why are prices going up all of a sudden? The answer is something called inflation, and it's not just happening in one specific country either. A whole host of countries worldwide are experiencing what some people call an inflation crisis. There are a few different ways of measuring inflation. The Consumer Price Index, CPI, measures the average change over time in the prices paid by urban consumers for a market basket of consumer goods and services. Very simply, inflation means that the cost of things increases. For example, if a $1 jar of jam goes up by 5 cents, the price is inflated by 5%. Inflation isn't necessarily always bad, but it can present some challenges when prices increase too quickly or keep rising for too long. Many countries worldwide are struggling with inflation, and the many governments claim that the pandemic is one of the biggest reasons for this. Many households built up an incredible savings due to having fewer opportunities to spend while working from home and closed shops, for example. When restrictions started to lift, these savings poured into the economy precisely as hoped. The problem is that with many countries worldwide still facing strict COVID-19 regulations, lacking access to or uptake of vaccines, or continuing to dip in and out of lockdowns, there aren't enough products to go around. Fewer businesses are working with fewer staff, producing fewer items. Despite all the money going around, businesses can't quite keep up, and prices are rising as a result. A more recent driver of inflation is Russia's ongoing conflict with Ukraine. This has led to higher commodity and energy prices, which means it costs more to fill up our cars and heat our homes. 5 key drivers of the current inflation surge. Suppose you've been closely watching the news and your weekly shop. In that case, you might have noticed that the price of things is going up. A liter of unleaded petrol is today almost 50% more expensive than a year ago. Household energy costs increased 54% in April 2022 alone, while even crisps and soft drinks are becoming more pricey. U.S. inflation is currently running at 8.5%. We see 5 key drivers of the current inflation surge with implications for this debate. First, the pandemic has 2 different effects on global supply chains. In the early phase, lockdowns and mobility restrictions led to severe disruptions in various supply chains, causing short-term supply shortages. Second, a shift in demand towards goods and away from services. The pandemic brought about a significant initial change in what consumers bought. Spending on goods rose dramatically. Consequently, much of the rise in inflation in the near term reflected inflation in durable goods, including used cars, while service inflation increased only moderately. Such shifts may persist only during the active phase of the pandemic, but at least part of the shift in demand towards goods and away from services may continue, given how the pandemic has reshaped society. Third, aggregate stimulus and post-pandemic recovery. About $16.9 trillion in fiscal measures were announced globally to fight the pandemic, with relatively more extensive support in advanced economics. A $1.9 trillion fiscal stimulus, the American Rescue Plan, was introduced in the United States alone. A warning that the significant fiscal stimulus combined with easy monetary conditions would lead to high persistent inflation came from a group known as Team Persistent. The name can be traced to inflation warnings in early 2021 from Larry Summers and Olivia Blanchard, among others. Fourth, a shock to labor supply. Labor market disruptions from the pandemic continue even 2 years after it began. Labor supply participation remains below pre-pandemic levels in several countries. Among advanced economies, the impact has been relatively more considerable in the United States, where participation is about 1.5% lower than before the pandemic, about 4 million fewer workers. Fifth, supply shocks to energy and food because of the Russian invasion of Ukraine. February 24, 2022, invasion has led to rising energy and food prices, which will inevitably mean higher inflation globally. Russia and Ukraine are exporters of primary commodities, and the disruptions from the war and sanctions have caused global prices to soar, especially for oil and natural gas. Food prices have also jumped. Wheat prices are at record highs. Ukraine and Russia account for 30% of global wheat exports. These effects will cause inflation to persist longer than previously expected. The impact will likely be bigger for low-income countries and the emerging markets, where food and energy are a larger share of consumption, as high as 50% in Africa. How will the central bank respond to inflation? If the past indicates the future, examining how central banks acted before the pandemic is helpful. Until the late 1970s, the central bank was more tolerant of inflation, but the dramatic disinflation in the United Kingdom under Margaret Thatcher before Bank of England operational independence, and by the Federal Reserve under Paul Volcker, brought about a revolution in how central banks respond to inflation. Soon after, many other central banks followed these two salient examples, bringing about a decline in inflation in much of the world by the mid-1980s. This required significant institutional reform towards central bank independence and the ability of some central banks to navigate political headwinds. It's common for central banks to copy successful strategies of other central banks, although this often requires institutional reforms. High inflation made it more likely that central banks would imitate strategies that seemed successful in reducing inflation. In addition, various reforms made it possible to staff central banks with economists and others trained in the causes of the great inflation of the 1970s and ways to bring inflation back down, which plausibly also played a role in this central banking revolution. What is the impact of inflation? Everything consumers need to start paying more for everyday items. Households will increasingly find their money is worth less. After all, if everybody has to pay more for a grocery shop, there's less money to spend on other things. But inflation can be particularly challenging for savers, homeowners, and those already retired. If you've been saving for a long time, or paying off a mortgage, or drawing on a fixed pension pot, you suddenly have to pay more with less. The last time inflation was this high was 40 years ago. While this occurred before some of you were born, you may remember more recent events such as the 2008 global financial crisis. Back then, inflation reached just above 5%. As inflation rose and interest rates fell, savings accounts could no longer keep pace with the rising cost of living. One of the most common ways central banks and governments combat inflation is by changing interest rates, the amount of interest you will earn on your money when placed in a savings account. If the interest rate goes up, people will save more and spend less, making item shortages less acute and, in theory, bringing prices down. This will also impact things like mortgages, however. Higher interest rates can mean the amount that you'll need to pay on a mortgage could increase. As with all financial questions, having sound expert advice is paramount. If you aren't sure, it's better to get clear guidance rather than try to guess what to do next. Inflation during the remainder of 2022. So, the big question on everybody's lips is, will the recent interest rate rise curb rising costs? While it's been good news for savers, homeowners who aren't on a fixed-rate mortgage have seen their monthly mortgage payments rise. The BOE is expected to increase interest rates again when it meets in August to stop inflation from spiraling out of control. Inflation is forecasted to rise to around 11% this year. Inflation has been driven by COVID-19, Russia's invasion of the Ukraine, and supply chain-related issues. These shortages are driving higher prices, making living costs more expensive. Should this inflation rate continue, savers, homeowners, pensioners, and many other people will be looking at some challenging times ahead. Inflation will likely continue throughout 2022, with inflation expected to hit double digits later this year. Governments and central banks are trying to control inflation by increasing interest rates. Getting the right financial advice for your circumstances and doing your research before making any decision is critical in challenging times. And remember, always invest what you can afford to lose. Thank you for taking the time to watch this video. Don't forget to smash the like button and subscribe to be the first to watch the following videos and for more blockchain, crypto, Web3, NFT, and finance updates and news.